So I'm not a Wharton or University. I'm an MIT guy, and I don't require hardly any partying. It was nose to the grindstone of chemistry and economics with Nobel laureates. So,
Except on Friday night.
huh?
Except on Friday night.
Yeah. I don't recall it. So maybe I was just working too hard. Anyway, so I've been running Alignment Ventures now for about 10 years. In the first fund, we put about $2.5 million to work. That was my money from prior successes. I've also been a partner at another seed stage venture firm. I raised $35 million with Medical Innovation Partners, investing in medical device deals at the seed stage. And then prior to that, I was at Norwest Venture Partners, which now is a $12 billion firm, really private equity now. But at the time, they just raised a $500 million firm. And I invested in life science deals across the nation for Norwest. So in between, I've done nearly 20 years of operational work. Most recently, I was the CEO of a company called Tippie. I spun out of Oregon Health Sciences University, the medical school. And it was an immunotherapy company that was acquired by Vir Biotechnology in 2016. Vir is now a $5 billion public company with 11 drugs in the clinic, 2 of which are ours from Tippie. So Marty asked me why family offices. Well, we're raising a $75 million fund right now to do 10 de novo startups. So we start these companies out of university technology from fundamental science. I'm a chemist, medicinal chemist by training. I worked at Syntex. I had developed one of the first antiviral drugs, ganciclovir, with John Martin, who then went on to build Gilead to a $150 billion company. So I've seen this process from start to finish. And it's hard work, it's deep science, and people are extremely important, the very best people. So we're raising, like I said, $75 million to do 10 startups. The strategy is to put $300,000 to $500,000 in at the university stage. So we're investing in risk reduction in a university faculty members laboratory first, in a completely virtual setting. Do these 3 experiments. If it works out, we'll go on to the next stage. The next stage is we'll invest $3 to $5 million to further reduce the risk and get ready for a Series A. During this time, the pre-seed and the seed stage will be, we put in one of our venture partners. So this is an experienced entrepreneur. This is not a recent postdoc. This is somebody who's been through the process before and understands how to build value. So that individual will be the interim CEO for the pre-seed and the seed stage, typically to maybe even 3 years, until we get to the point where we can raise a Series A, at which point we will recruit the right long-term CEO, somebody who has deep domain experience in that exact niche. And that venture partner who has been this interim CEO will back out and do it again, or perhaps move into a business development situation in the new company. But we are very set on the idea that when we get to the Series A, it has to be somebody who's really been through the ringer in that exact niche before. So why family offices? Well, they're great limited partners, first of all. Second of all, we will invest maybe $2 million in an A round. That A round for a pharma deal may be $30 million, for a device deal may be $10 to $15 million. So we really need additional investors who know us, who followed our deals, to help at those later stages. And so the opportunity for a family office is to follow the company's progress in the seed stage and even the A round, and then be able to invest or be able to have the opportunity to invest in the B, C, D round, or whenever they want to come in. So, we are creating companies from scratch. We are not relying on others' deal flow. We are creating them, and we are a source of deal flow from other investors. And we have, long relationships in the business. I mean, at Tippie, for example, before I came in, 5AM Ventures, one of the premier seed stage venture capitalists in the Bay Area, had spent 2 years trying to get this company off the ground. They put in an MD to run the company, couldn't get it to fly, backed away. at that point, I came in and we took it to the acquisition in about 2.5 years. It took. It was hard work, but it was doable. So, invested with some of the best in the business. When I was at Norwest, for example, I did my apprenticeship with Larry Bach. Larry was a general partner at Avalon Ventures. And Larry is one of the premier, well, Larry's passed now, but he was one of the premier seed artists in the business. Larry did 22 companies worth over $100 billion using the model we're using right now. Vertex, Neocren, Illumina, and on and on. You go in, you do the hard work, you understand the science, you get the IP right, you get the right people, you get the right experiments done, and get it to lift off. But the hard work, the initial hard work, is something that very few people do. Even the largest firms. I mean, when I was at Norwest, for example, and I'm seeing this right now, it's a classic response to a recession or a downturn. You preserve capital in a big fund for your existing portfolio companies. You bayonet the wounded. And seed stage investing, why do that when you could do later stage investing and support your portfolio and keep them from going? I mean, I just got an email yesterday, Khosla Ventures, please help us in this $20 million Series A. Why need my help? These are hard times, and in hard times, there's retrenchment and there's tremendous opportunity in the early stages, because it's an inexorable flight from early stage venture capital when you're in a big fund. It's just the mathematics is inexorable. So we think there's a tremendous opportunity to seed stage capital now. In terms of let's see what
So from being with Norwest Ventures, you must have a fantastic network also, whether it be seed,
oh yeah,
seed,
sure,
later stage.
sure, Kleiner, Mayfield, Greylock, all those guys, sure, yeah, I know. Yeah.
When you look at deal, do you say, well, this is a great fit downstream or upstream for us guys? So we know this is a great deal, and we know that we could probably get funding from it in Series A, Series B from those guys to kind of.
Yeah, I mean, you don't start a company with the idea in mind that this is a great fit for Greylock or Kleiner or whoever, but it becomes pretty obvious as time goes on, and as you hit those risk reducing milestones, which larger fund that might fit into. And it's not just the venture capital firms, it's private equity firms, it's individuals, it's everybody we've met in our 30 years in the business. I should mention my partner Laura Smolier is also a key asset. She's a PhD from Berkeley in chemistry. She also did not party in school. And she's a 2-time successful entrepreneur. She's coming out of a recent fund called the Berkeley Catalyst Fund that she did 26 investments there. So she's highly plugged into the Bay Area venture capital scene. And I don't do just myself. I tend to work all over the Western United States. So I've looked hard at deals in Texas, in Colorado, in Utah. My 2 most recent companies are in Oregon. I did a significant financing, $50 million financing of a company in Seattle. I'm looking at another one in Seattle right now that I think is very exciting in arthritis. So, I don't confine myself just to the Bay Area. It's the entire Western United States.
Michael, if I can give you a plug, because we sat together last night at dinner and met. I'm a big fan of everything you're doing. So to the extent you need a big fan. I mean, I work with Columbia. They've had so many spin outs. It's very successful.
Yeah.
Mount Sinai, a lot of hospital systems doing the same thing. I think going back 7 years ago when I first got into the family office space, I met more people, private equity, that were interested in investing in the private equity kind of later stage companies. But as I do more work, there's more investors interested in exactly what you're doing. Because if they can get single digit valuations and a real chunk of the company at an early stage, and especially in biotech, which you focus on, you get some good data back. It could be some really amazing returns that you just can't get later stage. So big fan.
Thank you. Well, I should introduce you to David Present, who's in that space. David's a good friend of mine. He was an orthopedic oncologist at Mount Sinai, then moved to one of the first hedge funds that Weisbeck and Greer started. And Dave just did a deal. We're out of Mount Sinai and Columbia, $800 million gain. in 3 years' time. He pulled me into that deal.
Yeah,
Amazing guy.
Several orthopedic surgeons that worth hundreds of millions have their own family office.
Yeah.
Yeah, have a deal coming out of a university now where exit will be 2 years based on favorable data.
Yeah.
So there's real money there,
There is.
but investors are still focused too much ways.
Well, fantastic, Michael. Listen, actually, a great presentation. Thanks so much for just